Hey guys, Sean from My Mortgage Freedom or Rate Tracker, just touching base to cover off on an update regarding the interest rates and a little bit more about what the banks seem to be framing their position to do in 2023 and probably into the start of 2024. I think there's going to be a big push for fixed rates. Had some customers come to us in the last couple of days and already start talking about, should I be fixing for 3 years or should I be staying variable? There's a very, very, very clear cut answer here. And I think that is the banks want to encourage you to consider fixing for 2 years, 3 years. That's why those 2-year and 3-year fixed rates are the most competitive. We're going to have a quick squeeze at the ING rates, and I use ING because they're a pretty well-regarded, reputable lender. Going to their owner-occupied, this is also important. Always make sure you're comparing apples with apples. Owner-occupied versus investor, the rates are going to be different. If you are a owner-occupier, the variable rate at the moment for a sub 80% sitting around 5.24. That's pretty solid in the market, pretty well regarded. That'll compete with a lot of virtually any lender in the space. Now, when we go down to these fixed rates, you look at the time in which you would be fixing for. So the cheapest fixed rate available is 5.34%, and that is for 3 years. 3 years is a super long time, especially now. When you look at the sort of global macroeconomic situation, we don't really know where things are going to go. I definitely would not be putting my money on a 3-year bet at 5.34%. The 2-year and 1 year are a little bit less appetizing at 5.44. Now, that it may only be a small difference. If you came back and looked at these a few months ago, probably before this period here. So this chart is the 2-year government bond yield. Now, as soon as this started flatlining and going sideways, this is where the fixed rate started to stabilize. Fixed rates started going bananas back in around Melbourne Cup 2021. So if we look at this, we go back to around that October, November mark. Look at the speed in which the bond markets increased. That is because everyone was going down a super conservative path, pulling money out of risky markets and going into something more guaranteed. Of course, of which it's gonna really force that market to increase at an exponential rate. We haven't seen that kind of market action for a very, very long time. You can go back we're back here in 2015 and whatnot. Now, if we wanted to look at how this might shape next year, I say that it's a really bad idea to fix this year, because if you're fixing at 5.34 for 3 years, that puts us into the middle of 2026. I can guarantee you we're not going to be paying rates in the mid to high fives, which is what it would need to be in order for this to even look possibly or remotely attractive. Very real possibility. The same thing happened in 2018, I think it was 2017, 18. Banks started flogging fixed rates, 4.99, 4.59, 3.99, 3.59. It just kept dropping and dropping and dropping. Now, the fixed rates were dropping, but the variable rates would trail, and they took longer to come down. Naturally, the market needs to acclimatize. As the fixed rates come down, I would expect that the variable rates are going to do the same thing this time on the way down that they did on the way up. Look at this timeline. October 2021, fixed rates start climbing insanely quick. Now, the variable rates didn't start kicking off until about here. Now, that's already 6 months worth of increase in the fixed rates before the variable rates even moved. So if you're being encouraged to fix at 5.44 or 5.34, depending on what sort of products you're in, I would be very, very cautious fixing anything in 2023. Let the next 6 months roll out. You've already come this far on a variable rate. If you're lucky enough to have a fixed rate up until the last sort of few months, then great. You've dodged the majority of the bullet or the spray of bullets. Do not go and commit now to a 2 or 3 year period at a rate that is, effectively not much better than this after this goes up one more time. So fixed rates have not moved. The variable rates, as at the 8th of May, they have actually moved. That will go up to 5.49 in the next few days. So the fixed rates have now dipped below the variable. This is where everyone starts to get really anxious and sort of excited about these fixed rates. They're a really, really shitty idea, and it's a trap in order to cause you to pay more interest over the next 2 to 3 years. Avoid it and wait and sort of make a more educated guess when we know a little bit more about what the future looks like. Right now, it's all up in the air, and I would suspect, based on the banks pricing these in at such a distance, that they expect us to be going down in at least within the next 12 months. What do I think for variable? I think there is probably still room in that. You know, we would be close to the ceiling. There is probably still room for another move up. As we know, without going into all the jargon that the news love flogging, we still haven't seen the existing rate rises take effect. There's still, you know, cars are still flying out dealerships. Designer goods are still flying off the shelf in city shops. Retail spending has been affected now. It took its time. Like, we didn't really show much lack of strength in our spending, and we're still not. It's basically like we've told the government, you know, everything's become more expensive, but it's almost like we've just become accustomed to paying more for everything, and we're happy to. And you know, the reduction in what people are spending for an average household has not dipped as quickly as they expected it to dip. We're really only just sort of starting to see that now. So I would expect for the next few months, play it safe. Do not fix for 3 years at these crazy rates. If you're upset about what you've been paying up until now, then why would you go and commit to that for another 3 years? If you have any questions about that, reach out, let us know. I just wanted to give you that little bit of a heads up and try and educate you to make some really pragmatic decisions over the next few months. And we will keep you up to date. If we see anything shift, if we think there's anything going to be significant sort of change in the macro or microeconomic environment that's going to impact you as our customers, then we'll let you know. But for the moment, yeah, stay put and reach out if you haven't had your pricing reviewed by us. In the last 6 to 9 months, we've been through pretty much everyone in our entire list. If we have missed you or we haven't been able to get in touch with you, reach out and we'll get it sorted for you. Yeah, be safe. We'll chat to you soon.